Hi, I'm Mark Persano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So today we have our EIA show. So today we're going to have our EIA show and our frac spread show, and then we'll skip some of the econ for next week. It was a short week. We do have some data that we'll talk briefly about during the FSC show, but we'll try to keep it light and help everyone get to a very happy Thanksgiving. So in the first segment, we're going to go through really what's happening with global diesel, global flows in general, just because there's a lot of different moving parts. You know, we've talked a lot about Russian flows, how that is changing the landscape, but there's also been a lot of discounts in the physical market, a lot of pressure. So we're going to go through that a little bit in segment 1, but a lot in segment 3. Then we're going to talk about how demand softened ahead of Thanksgiving. A little counter-seasonal, but it just means that we should get a bigger makeup next week, or I should say this week into next week, and then this and next should be fairly sizable when we look at some of the flows. And then we really want to dig into the global differentials, especially in crude, because they've weakened across the board. And I think that's really putting more pressure on the paper markets as well. But the physical market is showing a lot of cracks, especially when you look at what's happening in the Middle East, in West Africa, and how that's impacting and how that's flowing down into Asia. So with that being said, let's kick it right off. And here you can see total product flow, total product. So the deficit widened from 11.2 to 20. And you can see that it's right in this tightening point in terms of where we are. That's total oil and products. Nothing too surprising there. When you look at crude stocks, both land and floating, we're right, almost right on point when you look at where we've been over the last, since essentially 2017 through 2021. And then when you look at total oil and total oil products, you can see that the deficit narrowed from 25.1 to 19.9. But it's important when we look at where some of these things sit at the moment. And you can see here how the product side, still on the short side, mostly driven by diesel, or I should say middle distillate, with light distillate still on the higher end. But we want to look at how those dynamics could continue to shift and what the weakness in trucking and what a global recession really means to the demand for middle distillate. So then we take that to the next level and we'll look at land storage. Here you can see land storage, the deficit widened from 36.5 to 42.2. This usually start to see some of that rollover. We're still above where we were in 2021. Based on what we see in the market right now and the amount of tankers being consumed, and we have a good chart in segment 3 showing you how a lot of these older tankers are coming back online, or at least being used in ways where they used to be more storage based, is because there's so much crude that is currently in transit. It continues to be the case, and that's something that we're going to want to talk about. Land storage in the west of Suez, deficit widened from 17.9 to 28.8. Some of that will reverse because we've had a decent slug of floating storage come into the U.S., and an elevated amount remain in Europe, which is going to support additional land storage into west of Suez. As east of Suez has grinded a bit higher, deficit now from 17.5 to 9.7. And that's as more of those cargoes show up in east of Suez, it's going to push us much closer to normal. Now on the floating storage side, the surplus widened from 13.9 to 27.3. So remember, we talked about how a lot of stuff went into transit. As things show up and then get moved into floating storage, that is just that timing delay between transit, floating storage, onshore storage, and you can see that we've gone from the floating side, from the transit, starting to accumulate that floating storage, and that continues to widen, and that's going to keep things elevated. West of Suez, the surplus widened from 0.1 to 4.1. A lot of that we're going to want to talk about is actually driven by the U.S. Some of that is holiday related. You know, you'll see some of those that clear. That's just going to push a bit more into the into pad 3. But you also have to think about kind of getting away from the tax man in general. And you want to, some little tricks, and not to say that they're doing it right now because tanker rates are so expensive, but in order to get around the Jones Act, if you load a foreign vessel, send it into the water, and then take that same vessel and take it not only into the same pier, but to the same slip, it's not deemed an import. Which just means that, say we leave from Pier A, slip 1, we have to re-enter and go into Pier A, slip 1, and that's not deemed an import. If we go into from Pier 1, slip A to Pier 1, slip B, that is deemed an import and illegal against the Jones Act. So there's ways around that. So that's when, as we get towards the tax counting barrels, you can start to see some of this little bit of movement, and those are things that we want to address. But with that being said, the storage that has come in so far on the floating storage side in the U.S., a lot of that is showing up from West Africa, and that's going to continue to be the case as we try to create some sort of amalgamation of crude grades to create and maintain our distillate production. Because even as things weaken a touch, you can still see it's still very rich. So when you look at Northwest Europe, you can see that diesel premiums to Brent crude is still over $35. And you can going back through 2012. So there's still an incentive to make diesel. And then when you look at the U.S., you can see that we're right at about $62. So again, we're still at the lower end of the range, but still moving higher. And what diesel's going to do in the U.S. is going to be driven based on what does Mother Nature throw at us. Are we going to get a colder winter? If we do, that'll accelerate demand on the heating oil side, because trucking is just under so much pressure. XPO is the most recent trucking company that has announced furloughs. So we're seeing more and more pressure on the trucking side, and that just, again, speaks more towards the demand and economic conditions, which are weakening, which is, again, one of the big headwinds in the diesel market. So when you look at crude had a draw of 3.69 million. The big draw came from Pad 3 with a drop of 3.88. Pad 3 still 3.9 million over the 5-year average, still 1.2 million over the year-over-year. The big drop still remains. Pad 2 had a drop of 140,000, Cushing 890,000. We did get a big increase in imports coming into Pad 2 as force majeure ends, as we get some more activity coming down from Canada and some of that normalizing. That we should see that not so much huge builds, but at least the draw slow. Cushing, same thing. And then when you look at Pad 5, Pad 1, fairly in line, not too much there. And then once you factor in the SPR, we're sitting at about a draw of 5.29 million. So again, something fairly standard. We're not seeing too much craziness. But when you look at the SPR and those draws as we head into a bit slower demand, a bit of that softness in terms of the amount of barrels sitting in floating storage, it actually times fairly well when you think about the end of SPR releases as we get into December, and then where are we, and then reassessing some of the different movements. And we're going to talk a bit more about some of the rumors that came out from OPEC in segment 3. There were rumors that saw that OPEC Plus was going to raise production by 500,000. Then everybody vehemently denied it. It's just tape bombs, and we're going to talk more about why that would happen, why that matters more in segment 3. So here, when you look at Pad 3 in the U.S. or the Gulf of Mexico, we're following almost exactly where we were in 2021. You can see here there's not too much to say in terms of Pad 3. Exports are going to still remain at about 3.8 million. We've been right in point on point with that view, and we don't see that changing in the near term. When you look at Cushing here, you can see some of those pretty extensive drops. There's typically a lull, and then when you look at some of the activity, then you get a bigger increase into year end as the force majeure ends, as some of the imports from Canada remain robust. We think that is going to continue to move higher, not exponentially higher, but close somewhere near where we were in 2021. Then when you look at runs, you can see here that runs still remain elevated. We're running hot. The activity went from 92.9% to 93.9% utilization rate, driven by Pad 3 and Pad 2. So that's we should now start to get to the point where we're going to hold around 95. We should get a bit of a drop this week just because things slow down a touch just for Thanksgiving. So we could print something closer to 91, maybe 90.5, but typically then there's a quick snapback as we get to the other side of Thanksgiving. But just to give you an idea that if there's a big drop, it doesn't really mean much right now. It's just because even with gasoline weakening, it's still strong enough, as well as with diesel, to support maximum runs coming from the U.S., which is holding firm here. Then when we look at utilization, here's just giving you an example of where utilization rates are. We continue to see this moving up. It's trending faster than normal seasonal moves, but you can see that we're still moving in line with where we should be, with getting to that peak as we head into the end of November, and then really kind of maintain that peak through December, through the first few weeks of January. And then you start to see some of the slowdowns depending on timing between January and February, with full-on turnarounds as we get into March. Imports, a nice big spike of 1.5 million barrels a day. That was driven by Pad 2, as we were talking about that snapback of 589,000 barrels a day. Pad 3, 306,000. Pad 3 is the one that, given what's offshore, should stay a bit elevated. There might be a little bit of a gap driven by the issues on the holidays in terms of timing. And then when you look at the West Coast had a nice increase of 601,000 barrels a day, and that still remains lumpy, but again, still remaining fairly strong as we go into it. And then Pad 3, you can see that it actually almost followed exactly what happened in 2021 with that stronger bounce. Again, it'll just remain a bit more elevated, especially given what's offshore, as we try to bring in some of the heavier barrels and maintain a healthy distillate cut. Pad 2, you can see that big spike as things came back online and normalized. Now that we get a little bit of that normalization, we'll stay closer above the 5-year average, and again, staying above in that top end of the cloud, as it still makes a lot of sense to bring Canadian crude and into Pad 2 and Cushing. Implied demand took a big step down. You can see that gasoline was down 415,000 barrels a day. Distillate, another move to small movement down 17,000. Distillate, unless we get some severe cold, we're likely going to hold something closer to 3.8, 3.9. So that's going to be an interesting one to watch. Jet, right, again, 1.45, 1.55. We're right in line. And then propane had that small decline, which is really matching up with some of the issues we're seeing on the petrochemical front. Now, when we look at gasoline demand, you can see that there's typically a drop, but there's normally a bigger spike first. So it's all about timing, and it's all about when. So does that mean that we're going to get a bigger spike this week and into next week? I think the answer is yes. Again, it's the average. People drive a significant amount during Thanksgiving. It's one of the biggest travel times of the year. So I don't think you can look at this and say, oh, well, the EIA is lying. It's like, well, no, you have to look at the 4-week rolling average. You have to look at where this is. And I do think we'll get a bit of a snapback and a quote unquote makeup number as storage is pulled down, and then companies go and they refill the storage at the retail on the retail side, which will keep things fairly elevated. Crude oil inventories, excluding the SPR, right at where we were in 2021. You can see that things typically consolidate at this point in time, just given what's offshore and where things sit. I don't see much change in the near term. And then when you look at days of supply, again, fairly comfortable given where we are. Product, this is including oil and products. As we've been saying, literally from the beginning of this year, we expect them to manage this sideways with not much variation up or down. And that's as gasoline starts to build, we think you could see this creep back towards where we were in 2021. But again, we're not going to get this huge shift higher. So here's that pivot that we were saying, and normally the pivot starts this week or next week when you look at gasoline storage, but it's going to be a little bit bumpy. But you can see that it's not crazy for us to say that we're going to get a fairly sizable increase in storage into year end. Again, weather is going to be a factor. The more snow there is, the less people want to drive. The colder it gets, the less people do. And so you're just going to see some of this pretty stable increase. And then when you look at the organic chemistry of it all, when you increase your production of diesel, you inherently increase your production of gasoline. So this is going to be the one to watch, because if gasoline cracks get really cheap, if not possibly negative, especially when you look abroad, that could impact the amount of diesel available in the market. Distillate growing slightly, but you can still see well off the normal pace, and that's all driven by PADD 1 or the East Coast. Jet fuel, not too much to say, kind of sideways. Then when we look at what is happening on the curve side, you can see that the front month has gotten absolutely hammered, and we've actually moved slightly into contango. But you can see there still remains strength at the back end of the curve. Obviously, everything has moved down, but you can still see there's some of that support that remains for the curve at this point. And we think that that's likely going to stay the case. The front month has had a big move down. I would say that we've probably overextended a touch to the downside on the paper markets, especially in the front month. Not saying to take a shot, but if you wanted to, this would likely be a spot. I would probably wait till next week, just because Friday is going to be a very light day, and you don't want to get in front of anything interesting. And here you can see that the floating storage that we were talking about, big spike up. This is something that just tells us that you're going to get some decent builds. There was probably some timing delays. I think it's a little early to start to see some of those tax adjustment moves for crude. But this is more just a lot of that crude from the Middle East, the West Africa showing up and waiting for it to be offloaded. So that's what we have for you in the global picture and the high-level U.S. stuff. In the next segment, we're going to go deeper into U.S. refined products and demand as we head into Thanksgiving weekend.